Welcome to the Robert Hunt Financial Market Update. It's your host,
Robert Hunt.
And my son,
Robert Hunt.
And his nickname,
Bobby Hunt.
Where we look at the week's financial news that can be a bit
confusing,
misleading, and take you off course, and we have to make it
actionable,
understandable,
and clear.
What a week, and therefore, what a show. He's back in studio, Bobby Hunt. By popular request, we talked to his agent. We got on his calendar. Wouldn't you know it, you're back. How have you been, Bobby Hunt?
Good.
Have you been keeping your costs low?
Yes, sir.
You've been keeping your investing simple?
Yes, sir.
And that time horizon?
Yes, sir.
Good. That's what we like to hear. We've got an excellent show. 3 salient articles, as usual. We're going to look at, number 1, how to stop taxes from eating into your investment gains. So a little bit of tax talk, Bob. We then are going to be looking at gold. Now, Bob, what do you know about gold?
It's not that good as U.S. stocks.
Man, I'm telling you, people, there are no show notes. There are no show notes. This is out of the mouths of babes. Beautifully said, Bob. And then we look at a Wall Street Journal article. This is a trend we've noticed, Bobby and I. Private equity is coming to your 401k. Should you buy in? What do you think the answer is, Bob? That's why you're on the show. You're going to find out with the audience. But let's start here. How to stop taxes from eating your stock market gains. Let's do some definitional work. Bobby, what is a tax?
A tax is something where you pay people money.
And who do you typically pay when you're paying taxes?
The United States of America?
Typically, the United States of America. But we know there have been taxes that other governments have charged all throughout history. Can you think of any taxes or tax collectors in the Bible?
Yes.
What are some tax collectors you remember?
Oh, God.
Zacchaeus. Zacchaeus. Okay, so it sounds like taxes have been around for a long time. Well, wouldn't you know it, the Wall Street Journal, Miss Laura Sanders, says there is a specific way, that you can sell your stocks to be tax efficient. Now, when I say tax efficient, I mean lowering the amount you are paying to the federal government. And did you know that that is A-OK, Bob, to lower the amount legally you pay to the federal government?
Yeah.
Yeah, that's perfectly patriotic. You're not a bad American citizen if you seek to use the existing tax code in an efficient manner. This article talks about cost basis. So when someone has a brokerage account at Fidelity or Schwab or Vanguard, there are different types of cost basis methods that you can choose. And a cost basis, that's the price you paid for an asset. So when someone buys an asset for $100 and sells it for $100,
NASA, like the thing that goes to space, the brand?
No, not you said NASA?
I thought you said NASA.
Oh no, I said asset.
Oh.
I think that's a great clarification. Some of my listeners in Houston are always eager for me to talk about NASA. Not this week. No, this is an asset, Bob. If you pay $100 for a stock and you sell it for $150, your gain is $50. That's a taxable gain. Did you know if you bought various lots, they call them lots. Let's say you bought $33 one day, $33 the week after, and $33 the week after, all at varying prices, you would have a bit of a dilemma on your hand. Which lot, which tranche of the stock should I sell in a tax-efficient manner? Wouldn't you know it? It's a bit complicated with these brokers. So each one of these, Fidelity, Schwab, Vanguard, what I would encourage you to do, and I do this with the clients, go in and look at the cost basis methodology that you're defaulted into. It's been changing. It has been adjusting lately. I like what Vanguard's done. I haven't tried it myself. They have a new program called MinTax, Bob, where you just hit MinTax, and the software is supposed to give you a minimum tax exposure the way when you sell it. I like Spec ID. That's where you actually get to choose which lots to sell. The dangerous ones that you can be defaulted into without knowing it. First in, first out, last in, first out, that LIFO, FIFO, Bob. Sometimes they'll do other methodologies where you're just absent-mindedly selling stocks in your taxable brokerage account, and you could have a real problem on your hand. Now, since we're in the classroom and we're working hard at the RHF Market Update.
In the classroom, we're in your office.
The proverbial classroom, Bob. The proverbial classroom. Well stated. We're in the proverbial classroom. The listeners probably gather their children around the speaker and they're saying, "Oh, children, listen to the wisdom." in tax advantage accounts like an IRA, like a 401k, this stuff doesn't matter. You don't have to worry about your lots because it's tax advantage and it grows tax free when you pull it out. It's ordinary income if it's just a regular, and it's tax free on a Roth. So keep in mind, cost basis matters, and this is where I see people get tripped up because they're just not thinking about it. Now, here's a little gotcha. Did you know that some people, Bob, can sell stocks in a taxable brokerage account and have 0% taxes? Did you know that?
No.
Yes, you can. Bob, you're trying to call timeout. Why are you calling timeout?
There's something I see on your computer that I'm confused.
Well, forget the computer.
Halloween.
Forget the computer, Bob. We're live in studio. I guess live for us, recorded for y'all. So, Bob, did you know if you have $97,000 in taxable income or below for joint filers, and you sell these stocks at a gain, you can pay 0%. 0% taxes. So this is just something that's worth looking into, worth being mindful of. Next up, Bob, we're talking about gold. You reminded us at the show. What do you think when you think about gold as an investment?
It's bad.
Compared to what?
Compared to stocks.
I mean, guys, this guy, how old are you, Bob?
7?
7 years old, and I'm telling you,
8.
I tell you, close to 8, Bob, but the odds of you taking over this show are very strong right now. Do you think one day you might take over the show?
Maybe.
I think there's an opportunity. So, and Bob, you made
I'd
a...
rather be a professional sports player.
What? I had the same dream at your age. Keep dreaming. Dream on. Dream on. But did you know there's a chart I like to pull out, Bob? Whenever gold is in the news a lot, and it's a chart that, maybe I'll find it, maybe I won't. But what it shows is if you invest $1 in 1800 in gold, what is that dollar worth today, present day? Do you dare guess, Bob?
$4?
Yes. He's a day again, people. This is Amy Comey Barrett style. He has no show notes. He has nothing in front of him. He is absolutely correct. I must have told you this.
No, on the chart.
You saw on the chart. What chart?
It says from this time period to this.
Yeah, but it's not in front of you right now.
Yeah.
You just remember, okay, it's not in front of me. I couldn't find it. That's right, Bob. And then whenever we look at the U.S. stocks, it's something like, it's a humongous number, remember?
Wait, I remember seeing it. I think stocks was good, but U.S. stocks were worse than gold?
No, U.S. stocks were far better. From 1800 to present, far better. But here we go. Wall Street Journal article, gold prices top 4,000 for the first time. So that's per ounce, buddy. So gold surpassed 4,000 a troy ounce for the first time. What's happening? People are rushing in because they worry about something called inflation. So there was an inflationary shock in 1979, and gold is catapulting up, not as high on an inflation-adjusted basis, but getting close. So a lot of what folks worry about, Bobby, is something called the U.S. dollar losing either reserve currency status or inflation. Its purchasing power is getting lower and lower. So when you walk into the store, and what's a product you like to buy in the store, Bob? I can think of one.
I like to buy ice cream. I like to buy cake. I like to buy maybe a gaming console. I would also probably like to buy a toy.
Okay, so let's go back to ice cream. Do you know what ice cream costs at Tom Thumb for those little ones we get?
$5?
That's about $5, guys. You'd be good at prices right. Imagine if you walked in and it was $20 the next day.
I would not buy it. I would just leave the store and maybe just get something that's buy one get one for the cheaper than.
Yeah, you do the best you could, but sometimes with something called inflation, Bob, those dollars just purchase less each day. So what people will do as a hedge, and I don't think there's anything wrong with it, but you're exactly right. Over the long pull, you're better off with stocks. They will buy gold as a hedge. So just as Bobby Hunt stated, our core convictions here.
Do you buy gold?
I don't. Now this is, that's exactly what you should do. Put it to me live here on stage. Do I buy gold? I don't buy gold. Do you know sometimes I'm tempted to buy gold, buddy?
No.
And that temptation springs from what? Sometimes these articles. Sometimes I read about the national debt in the United States of America, Bob, and I worry, whoops, what if we have such a large debt that we inflate our way out of it, and therefore even stocks get caught up in a 1970s style inflation? But you know what I quickly do is I quickly take my thoughts captive. I realize I can't predict when that'll be. I don't know when stocks will, but what I know is from 1800 to present, gold went 4x and stocks went up a jillion x. And so I'll just focus on the big charts and not worry about moving in and out of gold. Good question, Bob. And now for our last article. Headlined, and we'll see, Bob. We might talk about Mark Twain. But headline, have you ever heard him? He's an author.
Maybe. I actually think I have, maybe.
Yeah, it's possible you have. This is a headline, private equity.
Well, I think you told me about it when you were saying I asked you what books are you reading.
Oh.
And I think one of the books you're reading are by Mark Twain.
I am. I'm reading a biography of Mr. Ron Chernow about Mark Twain. It's teaching me about investing. So the headline here, Bob, this is by Randall Smith. Headline, private equity is coming to your 401k. Should you buy in? Now, Bob, what's a 401k?
Money?
Kind of. It's a vehicle to save for retirement. 401k is the name of the paragraph in the tax code, so they nicknamed it 401k. What you do, Bob, is you're allowed to take a portion of your salary from an employer and set it aside without taxes, and it grows tax-free. And if you choose pre-tax, it grows. Guess what? Typically, there's been a ton of progress in this area. It used to only be really high-priced mutual funds in 401ks, maybe 20 years ago. Now, it's almost all low-cost index funds in 401ks. That's really good. But guess what's happening?
What?
There's something called private equity funds that are going to increasingly be allowed into these. And private equity funds are a very expensive way to invest. So, and it's private in that these aren't stock. They're not buying stocks that trade throughout the day, but they're buying private businesses. And they have something called lockup periods and fee structures. And it's very difficult. It's opaque. Difficult to find performance data that's comparable, whereas with stocks, it's very simple. So this is interesting. Industry boosters say everyday workers deserve access to private equity funds' return potential. Through the first quarter of 2025, data provider State Street said private equity funds beat the S&P 500 by 2.5 percentage points for the past 20 years. That's a huge...
2.5 percentage points.
So that's like if you earn 10% and I earn 12.5%.
What does that mean?
Well, annual returns. So do you know what 12.5 minus 10 is? What about 12 minus 10?
2.
There you go. So 12.5 minus 10 is 2.5. So they're saying each year there was a premium for private equity of 2.5 over, this is State Street saying it. Of course, the devil's in the details. So these are what the advocates are saying. Oh, you need this in there. It should, number one, it's a much more difficult game. So past returns are not indicative of future returns. And then it's difficult to find apples-to-apples comparison.
You said a game, you said 2 games. You said football on returns, and you said apples to apples.
I did say 2 games. Football returns and apples. Apples to apples is a homonym?
It's, you find, so one person's...
Oh, no, that's the game. I'm talking about the figure of speech. Okay. But what this shows, Bob, State Street's data, it's maybe not so fast, my friends, because... this is Nan Zhang, global head of State Street's Private Capital Index. He says the trend is clear. In recent years, the excess return of private equity has been diminishing. So there was a decade. They say 2010 to 2020 was a great period for private equity because interest rates were low, and that was helpful for returns. Now, not so much. And moreover, lack of transparency. That's what I was talking about, Bob. There are critics who will say that internal rates of return, this is a measure that private equity will use, they can be inflated by using subscription credit lines. These allow the funds to borrow money against investors' committed capital in order to smooth out the capital call timing. If that means nothing to you, just know that there is some monkeying with the scoreboard. So whenever you're wondering, oh, wow, how did this group publish this internal rate of return figure? It sounds like there's more than meets the eye, which is all you really need to know. What I think is the simplest way to look at this is private equity is generally going to have fees, management fees of 1.25 to 2% annually, and a 20% share of the profit. Now, it's quite possible. I expect that the private equity that BlackRock plans, so BlackRock is the large asset manager, they plan a new 401k line with low fee private asset allocation. That'll include private equity. So I actually think this could be good. I don't want to be the beta test, and I don't want you to be the beta test either. I think it will be much better for you over the long pull by keeping it simple and keeping your cost
low. Low.
That's right, Bob. And why do we keep our costs low?
So we can have more money.
Peace. Exactly right. Picture perfect, Bob. So I want to end with Mr. Mark Twain.
Oh, I thought you were going to do because you're in with.
Wait, we'll get there, Bob. We'll get to the punchline. But we have a little time left. The producers are telling me, what is that, 2, 3? Yeah. Okay, the director is telling me a couple minutes. Bob, Mark Twain was a man who made really a lot of money for his day writing. He was a prolific writer, wrote very famous books, but he was always broke. And part of the reason he was always broke is he was investing in inventions. He always thought if he could invest in the next invention or the next hot business idea, it would make him get rich quickly. Now, Bob, do you know what the Bible says about getting rich quickly?
You can get greedy.
True, so greed's a problem. But Proverbs chapter 13, verse 11 says, he who gathers little by little will prosper, but wealth gained hastily will dwindle. So whenever Mark Twain would be approached with an investment, he would get too excited about getting rich quick. And yet the Proverbs, the wisdom of the Proverbs says, no, that'll dwindle. And that was the case with Mr. Mark Twain. He got infatuated with the story behind an investment, the potential of outsized profits in a short period of time instead of simple investing. So acumen and excellence in one domain did not allow him to be excellent in another domain, which is sometimes why it helps to have an hourly financial advisor help you. Who do you think you should hire for an hourly financial advisor?
You.
Oh, that was nice of you to say. You didn't have to say that. He could have mentioned anyone, folks. He could have said anyone at all, but he mentioned me. The one thing, Bob, that I feel like you know, and that Lucy knows. Lucy Hunt just entered the studio. Please hold your applause. Lucy, how should our costs be? Should we keep our cost
Low.
on investing
Simple.
and our time horizon?
Small.
Because that's what's going to give us the best shot on our investing journey. Until next week.